terminated in FY16 since FY14. However, projects awarded per day improved marginally from 4.96 km per day during 8 months FY16 to 5.66 km per day during 8 months FY17, which is only 40% of the FY17 revised target award. As reflected from chart at bottom right, pace of execution has also improved from 4.11 km per day in FY15 to 5.53 km per day during FY16. It further rose to 5.66 km per day during 8 months FY17, indicating 14% growth on YoY basis. This constitutes 63% of revised target execution for FY17. NHI's focus has undergone a shift from all PPP-based awards in FY13 to majority of awards in EPC mode in FY14. In the first chart, we can see a gradually reversing trend in favor of PPP mode after FY14. In fact, the latest introduction of hybrid annuity projects have contributed 42% share in total awards during 8 months FY17. This is undoubtedly an attempt to revive the languishing interest of the private sector investment in roads. We now look at reforms initiated by GOI to tackle execution woes. Difficulties encountered in the land acquisition process has affected the project progress in the past, thereby resulting in an increased proportion of terminated projects, especially in FY13. Based on study of the projects awarded in FY16 and 8 months FY17, it is revealed that around 90% of the required land is at 3D stage at the time of bidding. Inviting bidding after acquisition of 80% of the land is a welcome move. Provision of deemed termination and clauses to issue final COD in case of completion of 100% work on the ROW available within 180 days from appointed date also protects the interest of developers and lenders to a considerable extent. Emphasis on physical progress-based payment terms as compared to financial progress-based earlier terms is also expected to increase the focus in execution. On the other hand, stringent clauses for levy of damages and encashment of performance security shall exert some pressure on developers for timely execution. Meanwhile, harmonious substitution of the sponsor and one-time fund infusion by NHAI are expected to aid in commissioning of the stall projects belonging to weak sponsors. However, lenders reluctant to give a first charge on NHAI's fund is an area of concern. We shall now briefly delve upon reforms initiated to improve project viability and resurrect investor confidence. Premium rescheduling has been completed for about 20 NHAI projects. With regard to 100% sponsor exit in TOT projects, nearly 20 transactions of stake sales have already taken place till December 2016. This momentum is expected to continue further in the medium term. With the introduction of InvIT, 4 infrastructure developers have registered with the SEBI. NHAI has already announced modalities for release of arbitration payment up to 75% of claims against bank guarantee. The process has already begun with arbitration claim reportedly been released to one of the infrastructure developers. Nearly 75 operational projects with a mix of EPC and annuity on national highways with a length of 4,300 km have been identified to be rolled over under newly introduced Toll Operate Transfer TOT model with a concession period of 25 to 30 years. This can result in substantial fundraising for NHAI. Introduction of new credit rating system factoring loss given default approach is a recent development which is expected to augment the funding avenues for operating road projects. We shall cover this aspect towards the latter part of the presentation. Reportedly, 27 projects with an aggregate length of 1,090 km have been awarded under hybrid annuity HEM model till November 2016. Now we shall share our perspective on HEM. While a lot has been deliberated in the industry on HEM, we shall try to seek answers on what are the key factors and perceived issues of the model. If we look at the positives of the HEM, they are in the form of lower sponsor contribution of 12 to 15% as compared to 20 to 25% in conventional PPP model. However, stipulation of 50% upfront equity commitment by lenders increases the sponsor's commitment, especially for the large projects owned by moderate to weak sponsors. However, availability of mobilization advances at bank rate is expected to help in takeoff of this project. Inflation index project cost mitigate the price fluctuation risk to an extent. Revenue stream is assured in the form of annuity from NHAI for the construction, O&M, and interest portion. Project life cycle defined as NPV of the bid project cost and O&M cost for the entire period is the bidding criteria as compared to premium or grant quoted by developer in conventional PPP model. This is to rationalize the aggressive bidding. Lender's interest is also partially protected in the event of termination. However, if we look at the recent trend of projects awarded and concerns under HEM, it can be observed that change in the bidding parameter to project life cycle cost and availability of NHI cost based on the estimates of recent months has narrowed the deviation between NHI project cost and bid project cost. Although this is a positive for the sector, 5 projects have been awarded with a narrow margin of up to 5%, offering limited cushion in case of cost overrun. Aggressive bidding in O&M cost due to front loading of EPC costs can result in modest debt coverage indicators in operation period. Working capital requirement is expected to increase for EPC contractors due to emphasis on physical progress for release of grant and uncertainty over factoring escalation at the time of financial closure. 4 projects with a bid project cost of rupees 3,374 crore and belonging to moderate to weak sponsor are facing issues in financial closure. However, developers with demonstrated execution capability, good financial flexibility, and clarity on O&M costs based on project design are expected to benefit from HEM. We will now move ahead to the assessment of care-rated road projects, beginning with under construction projects. India's bank credit exposure to road sector under PPP has grown manifold and stood at around rupees 1,76,000 crore as on March 31, 2016. CARE's rating portfolio covers nearly 40% of the total bank's credit exposure to road sector. As on December 31, 2016, the quantum of debt rated for under implementation projects stood rupees 27,617 crore with 80-20 split between toll and annuity projects. It can be seen from the chart on the right side of the slide that around 61% of the under construction projects have been rated under sub-investment grade category, out of which 28% are under default grade. This is largely on account of subdued project progress due to ROW issues and pending equity commitment from the sponsor in light of their weakened credit profile. Moving on to the next slide, we bring out execution risk assessment of care-rated under construction projects. Sponsor's ability to fund the equity commitment and cost overrun, if any, in timely manner is crucial for the under construction projects. Further, in many cases, sponsor also doubles up as an EPC contractor. Hence, we have bifurcated sponsors into 3 categories: strong, moderate, and weak, based on their liquidity, financial flexibility, and track record of project execution. As informed from the table, projects with 2,471 lane kilometers are progressing with marginal delay of up to 6 months, and 77% of them belong to sponsors with strong credit profile. Projects with 3,492 lane kilometers are delayed beyond 24 months, and 57% of them belong to weak sponsors. Balanced projects are delayed due to pending ROW and hence highly susceptible to termination risk. Nevertheless, NHAI's effort to resolve the ROW issue with focus on stalled projects has resulted in notable progress in some of the stock projects as reflected from the last row of the table. Projects with 2,608 lane kilometers and that of around rupees 7,000 crore are expected to achieve provisional COD on entire length by June 2017, owing to significant progress witnessed during last 2 years. Hence, these projects are considered as low execution risk for the analytical purpose. In the next slide, we observe that projects forming 47% of the total debt of under construction projects are at low execution risk. However, 35% of the total debt of under construction projects are still at high execution risk and awarded before 2012, out of which 60% is attributed to weak sponsors. Harmonious substitution of sponsor, one-time infusion of fund from NHA, and release of 75% of arbitration claims to sponsor can partially offset some of the concerns looming around the under construction project. We shall now focus on the expected quantum and avenues for the private sector investment. Over next 3 years, aggregate quantum of private sector investment is expected to be rupees 15,300 crore, with nearly 65% coming in from developers with moderate credit profile. Prominent options available with the developer are through refinancing of existing debt, stake sale in operational projects, InvIT, and QIP, IPO, or private equity funding. Of the 20 projects which witnessed stake sale, nearly 40% belong to the sponsor with a weak credit profile. Over next slides, we shall cover the rating dispersion of operational toll road project portfolio. Of care-rated road SPV portfolio, toll road projects of NHAI and state highways form the major part with aggregate debt of rupees 55,029 crore. Operational toll road projects constituted length of 22,263 lane kilometers and debt of rupees 31,535 crore. Debt backed by credit enhancement mechanism in the form of an unconditional, irrevocable corporate guarantee by a relatively strong sponsor constituted 35% of rated debt for the toll project. The balance comprises projects with no recourse available to the sponsor, necessitating adoption of standalone approach. Moving on to the next slide, we see that 80% of the operational toll projects are in investment grade rating, with 45% concentration in the BBB category. This is on account of time required in stabilization of revenue stream, leading to moderate debt coverage indicators and absence of DESRA and MMRA, owing to limited surplus generation. Major challenge for operational toll road project is the large variation in base case traffic estimates considered at the time of financial closure and actual traffic after COD. However, around 60% of the toll projects in A category with a debt of rupees 3,614 crore has been transferred from BBB category during last 1 year. Further, 80% of toll projects in AA category with debt of around rupees 1,500 crore has moved from A category. Improvement in the credit quality of operational SPVs is attributable to factors or combination of factors such as refinancing of existing debt with longer tenor debt carrying lower interest, change in ownership, healthy growth in toll collection, and premium deferment. Moving on to the regulatory risk for state highway projects, we have seen that over last 2 years, state highways has become more susceptible to political and regulatory risk on account of toll exemption of cars and state transport buses announced by 2 state governments. Although both the states have announced compensation policy, considering force majeure nature of the event, delay in the receipt of compensation can increase the reliance on sponsor support for the uninterrupted operations of the SPV. For analyzing the performance, of operational toll road projects, we have reviewed their ability to generate cash surplus based on waterfall mechanism as a key parameter. It has come to our notice that Desai has been created mostly in the non-funded form, while the surplus generated, if any, were advanced to sponsor in the interim period. Responsibility of renewal of such non-funded reserve lies with the sponsor. Therefore, sponsor's ability to support the project cash flow in case of exigency and renew bank guarantee in a timely manner is crucial. Hence, we have plotted project's ability to generate cash surplus against the sponsor's strength. Based on analysis, operational projects with outstanding debt of around rupees 15,150 crore and length of 12,000 lane kilometers are at relatively low risk considering their self-sustainable operations or limited support requirement from strong sponsors. However, projects with length of 5,123 lane kilometers and debt of rupees 8,234 crore belong to sponsors with moderate to weak credit quality and hence more vulnerable. Performance metrics also include projects with a debt of rupees 3,653 crore requiring relatively better support, indicating weaker cash flow generating ability and therefore riskier. The extent of sponsor support is expected to increase further during H2 FY17, considering the impact of demonetization. Exemption of toll collection for 23 days works out to be revenue loss of around 6% of overall toll collection estimated for FY17. NHAI has announced the policy for reimbursing the SPVs to the extent of 90% of the O&M expense and interest expense for the period of toll stoppage and extension of the concession period for the balance revenue loss. Apart from national highways, toll has also been exempted in the majority of the state highway projects, where there is no clarity yet as regards the modes of compensation. In the event of state authorities' decision to extend the concession period, in contrast to that prescribed by NHAI, state highway projects would face short-term liquidity challenges. Continuing on our demonetization impact analysis, we can observe from the first chart on the slide, operational toll road projects had witnessed healthy growth of 11% per annum and 11.25% per annum in average daily toll collection during FY15 and FY16 respectively. Despite subdued hike in toll rates, increase in traffic on connecting roads, and replacement of 3-axle vehicles by multi-axle vehicles are the prominent reasons for this phenomenon. Here expects moderated growth of 6% in toll collection in FY17, mainly due to prolonged monsoon and slowdown in the economic activity post demonetization. Nevertheless, toll collection is expected to normalize from Q1 FY18 onwards. The second chart on the slide reflects the lending rate of banks, repo rate, and 10-year GSEC, which has witnessed downward trend since September 2014. Lending rates have fallen by around 85 basis points post demonetization, and 10-year GSEC rates have also reached to 6.44% per annum. This trend is expected to boost corporate bond issuance in the sector by refinancing the high-cost notes, which in all likelihood shall partially offset the negative impact of demonetization. We now move ahead with the updates on refinancing activity in toll projects. During last 1 year, debt of operational projects with established track record of over 4 years and aggregate debt of rupees 6,350 crore had been replaced with a mix of low-cost loans and NCD issued by Infrastructure Debt Fund for a longer tenure. CARE expects further increase in pace of refinancing in the medium term for the projects which have established track record of operations, controlling stakes owned by strong or moderate sponsor, and tail period of more than 5 years. CARE estimates replacement of additional high-cost debt of around rupees 4,150 crore with a mix of low-cost debt, and NCD.
Thank you, Maulesh. I would now request Rajashree from Mumbai office to take us ahead with the topic.
Thank you, Ravina. A very good afternoon to all participants present here. We shall now discuss performance of annuity projects portfolio rated by CARE. CARE has a rated portfolio of operational annuity projects measuring length of 8,222 lane kilometers and debt of rupees 12,510 crores, out of which debt of rupees 2,000 crores has been backed by corporate guarantee. The next slide shows that of the rated standalone projects, NHI as the annuity provider constituted 45% of total projects with aggregate length of 4,531 lane kilometers and debt of rupees 8,543 crores. Further, in case of state annuity projects, Madhya Pradesh contributed the largest share of 55%. It is mainly on account of toll plus annuity projects announced by MPRDC, which is rated CARE Single A Issuer Rating, over the last 5 years, with annuity payment largely covering debt servicing requirements. MPRDC's track record of timely release of annuity and bonus annuity in case of early completion has improved investor sentiment and private participation in MP projects. The track record of annuity disbursals have also been satisfactory in states of Gujarat and Jharkhand amongst other states. The ratings of state highway annuity projects are typically linked to the credit profile of respective state authorities. We now move forward to our next slide on the rating dispersion of CARE-rated annuity projects. It can be seen from the first bar chart on the left side that 42% of operational annuity projects of NHI are rated the highest rating of CARE AAA SO. Projects appearing in AA or single A rating category have debt in the form of bank term loans. Variable rate of interest, absence of requisite DSRA and MMRA, and foreign exchange fluctuation risk in some cases were few rating drivers. Our next slide, we try bringing out the rating drivers for structured ratings of annuity projects. Various credit enhancement features and elimination of interest rate risk with the underlying issue being fixed coupon are prominent rating drivers for structured rating of annuity projects. These entities also have reasonable gap between scheduled annuity receipt date from NHI and scheduled date of debt servicing, availability of substitution risk for O&M contractor, amongst various other structural mechanisms to protect the interests of the investors. In the medium term, CARE expects refinancing to gather momentum, particularly in this space, which is now being presented in our next slide. What we can notice here is annuity projects with a term debt of close to 1,883 crores have already been refinanced with NCD issuance. On an average, nearly 3 years of operational track record was available with these projects. In the medium term, we expect potential refinancing of SPV debt aggregating rupees 4,520 crores for 2,666 lane kilometers with the mix of low-cost debt and fixed coupon NCDs. Such refinancing may likely be from projects which belong to moderate and weak sponsor groups. This shall in turn aid in bolstering their financial flexibility and credit profile. We now present average benchmarks for CARE-rated projects and analyze the O&M risk. Based on CARE's experience, we have arrived at key benchmarks for O&M and major maintenance activity in per lane kilometers for both toll and annuity projects of NHAI as well as state authorities. As seen from the table, the benchmarks for national highways is relatively higher than those of state highway roads, primarily owing due to relatively greater vehicular movement and stringent maintenance standards. Major maintenance cost depends on traffic volume, mix, type of terrain, weathering pattern, and quality of regular O&M activity. In case of annuity projects, major maintenance expenditure is expected to remain low considering low traffic levels. Typically, major maintenance requirement is undertaken once in 4 to 5 years, which can be spread over 2 years. In the past, CARE Ratings has observed instances of deduction in annuity disbursals due to non-fulfillment of major maintenance obligations as per concession agreement, especially in case of weak sponsor. Hence, creation of major maintenance reserve, fixed price O&M contract with reputed contractor, and availability of sponsor support to bridge the cash flow gap, if any, are crucial from the credit perspective. We now move ahead on our third section to discuss recently introduced new credit rating system for infra projects with focus on operational toll road projects. CARE Ratings, in consultation with the Ministry of Finance and other stakeholders, has developed a new credit rating framework for infrastructure projects to facilitate greater participation of long-term investors by enabling better risk-based pricing. Conventional credit rating for toll projects is based on probability of default, wherein delay in debt servicing could be due to temporary cash flow mismatches. For instance, longer stabilization period for ramping up of traffic, toll exemption announcements by governing authorities for certain period, and one-time expenses towards major maintenance are some of the prominent factors. Under existing method, credit risk assessment is based on the cash flow available for debt servicing during the tenure of the loan. Therefore, it is difficult to differentiate between fundamentally strong and weaker projects. A new credit rating system is introduced to address these shortcomings by way of incorporating loss given default, that is LGD approach, along with probability of default, that is PD approach, to arrive at expected loss, that is EL. LGD would typically emphasize on economic viability of the project while analyzing concession life coverage, termination payments, and various other credit enhancement features. CLC can be arrived by dividing the present value of cash flow available for debt servicing throughout the concession period by present value of outstanding debt. Expected loss, on the other hand, is a product of PD and LGD. Subsequently, scoring of expected loss shall be linked with the rating scale to arrive at composite rating under the new rating system. As we can see, there are multiple benefits of the new credit rating system. Firstly, it is not constrained by 1 day, 1 rupee missed payment approach. Ratings will also factor unique strength of operational toll road projects like a longer tail period, steady cash flows post-stabilization, adequacy of termination payment in conjunction with credit quality of authority, and structured payment mechanism. Besides, conventional rating scales will continue to be used for capital provisioning, while the new scale will be an additional input for debt market investors. Focus on risk-based pricing is therefore expected to deepen the bond market. We now move to some of the CARE's expectations from Union Budget 2017-18, which are a higher budgetary allocation towards road infrastructure. It also includes change in the income tax structure by permitting or clubbing of losses and profits of the SPVs with the accessible income of the holding company. We expect an increase in credit enhancement limit for the infrastructure debt funds. Also, abolishment of MAT, DDT, and application of Section 14A for the developers are some of the other CARE expectations from the Union Budget. To summarize, the key takeaways from today's session are going forward with interest rates heading south and investment sentiment being buoyant, capital market issuances are expected to rise. Refinancing and stake sale activity in operational road projects are expected to gain further momentum. The success of InvIT in Indian context and release of arbitration claim will pave way for easing out developers' balance sheets. Developers with proven project execution skills and good financial flexibility are expected to gain from the HAM project awards. The deciding floor and cap on the bidding parameters can restrict aggressive bidding and ease out financial closure in turn. While NHAI shall miss its target yet again for project awards and execution for FY17, but on an overall basis, we expect that the increase in the pace of execution led by reforms initiated by NH and DOI, they are expected to be a turning point for the road sector. We can now take up the question and answers.
Thank you, Maulesh and Rajashree, for your valuable input. We would now be taking a break of 2 minutes. Till then, you can put up your queries or questions in the slot provided. We shall resume after 2 minutes with our speakers again. So resuming with our question answer session, we have our first question from Mr. Prithvi Garg from Alpine Securities. He wants to know, with respect to TOT model, do you see any challenges in this model?
Thank you, Mr. Prithvi. If you look at the TOT model, it is basically an extended OMT model which will involve bundling of projects. So prima facie, there are three key aspects which will be crucial from the developer's viewpoint. Firstly is as the bundle shall be a mix of strong and weak projects, the mix of the bundling of projects should be attractive enough to generate expected returns. Typically, the developer may prefer the projects to be either contiguous or in the vicinity so that they can derive operational synergies and also find ease in monitoring. Second challenge, what we believe is it's expected that majority of the TOT projects to be awarded would have been erstwhile EPC projects. So in such a case, there will be a likelihood that the maintenance expenses which are to be incurred by the developer would be higher than the traditional projects which would have undergone regular O&M activity. And we also believe that considering the long concession period which spans around 25 to 30 years in a TOT model, achieving debt tie-up equivalent which is around close to 80% of the concession fee payable, that should be a challenge. Thereafter, like any traditional BOT toll project with similar concession periods, it too will necessitate refinancing at the end of the tenure of the project debt. So these are the large and the very prominent challenges that we foresee from the developer's perspective in evaluating the TOT model.
Okay. I would again request our participants to put up your questions in the slot provided. Till then, we have a next question in line from Ms. Akansha. Her question is, what are the challenges for fund mobilization from InvIT?
With respect to fund mobilization from the issuer standpoint for InvIT, what we foresee is the challenges can be multifold. Firstly, the ability to provide an attractive yield in an environment of interest rates volatility, that should be one of the foremost challenge. Secondly, the issuers may face challenge in obtaining a premium valuation for their assets, which in turn would depend upon a number of factors like sponsor credibility and experience, quality and revenue generating ability of the underlying assets, limited funding options which are otherwise available, and also the government policies. Also, InvITs would be competing with similar domestic products such as AIF, which offer more operational flexibility, and also they allow investors to invest in all forms of infra assets, whether completed or not, and without any restrictions. So InvITs will be exposed to specific sectors that may be subject to their own business cycles. And I mean, if we compare with against REITs, which have been backed by tangible assets, that could be a key factor for being, that will be a preferential investing choice for some of the investors. So we'll have to see how things evolve and the launch of InvIT happens to take us through the entire product.
Okay. So our next question is from Mr. Rohan Verma. He wants to know whether there have been any rating revision in your portfolio on account of demonetization impact.
With respect to the demonetization, well, there has been one rating revision or one rating downgrade to a D category from an investment grade rating of BBB category. Rest all of the projects which of CARE portfolio did not face issues as they had either availability of healthy cash surplus and various liquidity enhancement measures, or had sponsor support for debt servicing. Most of the other projects had no impact of toll exemption due to availability of DESRA or the surplus cash apart from the sponsor support. So there was only one revision which we have witnessed so far.
Okay. Our next question in line is from Mohit Muradia. He's asking what kind of competition is witnessed in bidding for HAM projects at present. Further, when HAM were introduced, the competition was low. I believe it has increased now. Are the bidders doing aggressive bidding in HAM?
Yeah, Mohit. In case of HAM project, initially the competition was low, but subsequently competition has increased. That is, and more number of bidder has also come. Even the bidder with a moderate to weak credit profile has also joined in the bidding. So, because of the constraint of the model is that because of the front loading of EPC cost, even with the substantial lower bidding in O&M cost, the bidder can become lowest bidder. So that could face some issue in the operational period. But now what happens that in 4 to 5 projects, those are facing issues in the financial closure from the lender, even after completion of 5 months from the signing of the concession period. So because of that, going forward, this would be rationalized. And what we also uh, suggest is that there should be some cap on the O&M bidding from NHAI in order to rationalize the aggressive bidding. And further, these projects are of the concrete road. So where the actually the major maintenance cost is very low as compared to the conventional bituminous road. So that is also the one of the reason for the aggressive bidding. So once we have some track record, then also we can comment details that what is the extent of aggressive bidding. But in the long term, the developers with a good execution capability, designing skill for the clarity of the O&M part that would be benefited from the end model.
Okay, our next question is again from Mohit Sonaria. What is the outlook with regard to movement in traffic over next 1 year or so? With demonetization expected to result in temporary slowdown in economic activity, what are the expectations on toll collection front?
Regarding toll collection, which has witnessed some slowdown currently, so we expect that from Q1 FY18, it is expected to improve again and reach to double digit next year. That is, there are some reasons behind that. The one is because of the some improvement, some growth in the economic activity. Another is that there are also currently some like NH3 that is in the process of four laning. So entire NH3 is in the process of four laning. So once it is four lane, then the traffic of connecting road will improve. So similarly, some of the stretches like Solapur, Rajashree and others, Aurangabad, Solapur, Aurangabad, those are also in the process of the four laning. So and the NH8 tenders have also declared. So once this connecting road develops, so then there would be a growth in the toll collection. Another factor that could contribute the toll collection despite slowdown is the overloading, because NHI has come out with the circular to charge 50 times toll for the overload vehicle. So now most of the developers have installed that batteries and started collecting toll on the overloading. So that could also lead to the higher toll collection despite lower traffic movement. And in the past, if we look at the 2015, so there is a traffic growth was not in double digit, but the toll collection growth is in double digit. So that is because of the conversion of the 2XL and 3XL vehicle into the multi-axle vehicle, because multi-axle vehicles carry a substantial higher rate. So that has also resulted into the growth in the toll collection. So if that trend continues for the other stretches, so that can also lead to the growth. So apart from the direct linking to the GDP of 1.2 times of GDP growth, these are also the supporting factor for the growth in the toll collection going forward.
Okay. Our next question is from Mahesh. What is the expected impact of the new rating model? Will it upgrade the existing rating or downgrade?
Actually, the new rating model that has been introduced to overcome the constraint of the existing model. So the existing rating that will continue. So because that is based on the probability of default approach. So that will continue, but the new rating that will act as a tool just to assess the project viability, like the earlier approach that is based on the probability of the default. Now in this approach, we analyze the project viability. Suppose there are two projects are there. One project has a concession period of 15 years and loan period of 12 years, and the other project has a concession period of 20 years and loan period of 12 years. So, in the first project, if we consider probability of default approach, if the traffic if there is some slowdown in the project A, first project, so that rating could be affected. But if we look at the longer tenure, so the second project has a tail period of 8 years. So in this approach, we factor the tail period. So that justifies the viability of the project. So and based on that, the investor can take a decision that, and they can link the existing rating with the new rating that is derived from the expected loss approach. So that will likely to benefit the sector and not likely to affect adversely.
Okay, our next question is, what is the expected toll rate revision for FY18? It's from Prevan.
Yeah, Prevan. From FY18, because the toll rate in National Highway project, so that are linked to the 3% fixed toll revision plus 40% of the WPI movement. So that is depend on the WPI movement. That is difficult to factor at this point of time. But in our assumption, we generally take 5%, 3 to 5% WPI to arrive at the final toll rate revision.
Next question in line is, what safeguards are bank asking for HAM projects and why?
Currently, bankers are insisting the upfront equity infusion to the extent of 15%. And the second is that they are asking for the aggressively bidded project or the project with a moderate to weak sponsor. They ask 15% or even more than 15% of equity commitment from the sponsor. So basically, there are two safeguards from the lender's perspective. First is the debt equity profile, and second is the equity commitment. Because the concern of the lender is that the equity portion is lower for the of the sponsor. So for the weak project, they would prefer these two things.
Okay. So we will come to a close now. I would again like to thanks to all of our participants for taking the time out and being part of this CARE ratings webinar. We hope the discussion was insightful and looking forward to your participation in future also. For any further queries or feedback, please write us at corp.com with corp.com @careratings.com. Till then, goodbye.